Last week, we brought you everything you need to know about target premium. So if you're unsure, be sure to check that out. This week, what do you need to know about TEFRA and DEFRA? This is the Life Insurance Financial Education Podcast where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with NetWell Finance.
All right, Carlo, there's a very popular content creator out there who puts out a lot of videos, and he loves to say, if your agent doesn't know what TEFRA and DEFRA are, you're working with the wrong agent. So what does somebody need to know, a life insurance agent or a client? What do they need to know about TEFRA and DEFRA?
Well, I think the most important thing to my mind, it is the history of it and what TEFRA and DEFRA kind of shut down.
Hang on a second. I got to interrupt you because in my mind, TEFRA and DEFRA, they don't need to know anything about it. I don't need to know the agent doesn't actually need to know anything about TEFRA and DEFRA.
That's absolutely true. I think I was going into some details about it, but I think the reality is most people, agents, clients alike, it really doesn't matter because these are things that are going to automatically take effect. One part that people talk about is the concept of a MEC and the implications of that. And so that is something that people might keep in mind. And I think that's actually related to TAMRA, I believe. But, nobody really needs to know any of those things other than what are the net effects of these products and how they affect the products and what they do.
All right, I think that answered the question. Let's wrap it up. No, seriously, though, you really don't need to know about it because the software handles all the numbers. If we plug in numbers into an illustration software and it gives an error, we're violating TEFRA or DEFRA. If it says it creates a MEC, we're in some way violating TEFRA or DEFRA. So we don't have to actually know why it's doing it unless we want to be really good at designing and using the illustration software, because there are some of them that will create an error, but they won't tell you exactly what the error is. You have to figure it out yourself. And this is where, if you just have some background knowledge, you might be able to figure it out. And TEFRA and DEFRA, they have to do with 7702 tax rule. It's not the MEC rules, but it does set the limits on the corridor of insurance. And the corridor of insurance is what's important to us later on in policies, when it comes to the underlying expenses, when we're trying to reduce to the minimum amount, when we have to decide what is the minimum amount of death benefit that we have to put X amount of dollars in. That's where those are important. But again, you don't have to know what these are. The software tells us.
Yeah, and what I was going to get at in the early part of this is the history of really these came to be because in the early 1980s or probably in the late 70s, people started using life insurance as a giant tax haven because they would take effectively zeroed life insurance and stuff in a whole bunch of cash. And now they would have this tax advantaged, legally tax sheltered vehicle. And that is really what was being done. And so with that, this rule of how much insurance you have to have or what constitutes life insurance, that's what these rules kind of put in place in order to prevent people from creating these massive tax shelters. And connected to what James said is when we design these policies and optimize these policies, we're kind of like button up on that border of what you can do with these policies and keep it as legal insurance, but still pump in a lot of cash and have it have a similar effect to what people were doing in the 70s and 80s.
All right, Carlo's going to be the strict teacher in this episode. I said we didn't even need to know about TEFRA and DEFRA, but he wants to tell you about the history and more about it. So if some of you are interested, then I guess we'll finish going over these things. That was a good introduction with the history. And I mostly joke here, but yeah, there are some things to know about, but I'll still fall back on my line that you don't really have to know about it to buy a well-designed policy, because The guy that likes to talk about that, saying your agent should know this stuff, he doesn't even design the best policies. So the main thing outside of the history and like why it came about, like that's pretty important. But it created two tests. We have the guideline premium test and the cash value accumulation test. And there is a difference between those two tests with how much corridor of insurance that you need to pay for and how the MEC limits end up getting calculated.
Yeah, and again, it's not really something you really need to know too much about, but when you're going and designing policies, if you're an agent or if you're talking to an agent, there can be some implications if you go with one versus the other, depending on the product. And so that is something that you can keep in mind. And there, one having this test, this 7-pay test, as a concept of how you can measure how much you can put in a given year. So really, you just don't really have to know too much about it. But in the end, there are certain products that will have the differences in how the policy acts and different riders and things that could be attached to one or the other.
Okay, so since we're going to get into the weeds, let's get into the weeds on these two tests. Because I do talk a lot to my clients about the guideline premium test and or the cash value accumulation test. We will normally use the guideline premium test because it comes with a greater ability to fund a policy. I should specify, this is in the case of IUL. You can choose between the two tests. Whole life just uses a cash value accumulation test. But in the IUL, you get the choice. And under the guideline premium test, we can put in money, a lot more money, for a lot longer under the guideline premium test than we can the cash value accumulation test. That's one reason we tend to use the guideline premium test. Another reason we use it is a lower corridor of insurance. So when we want to reduce that cost of insurance later on when we get older, we can do it more so using the guideline premium test. And the third reason that we use it, almost every carrier, they will not allow a loan protection rider or an overloan protection rider if we use the cash value accumulation test.
Yeah, and that's the big difference that I was kind of mentioning earlier. And that tends to be that escape hatch that we talk about. Now, in most cases, if properly designed and properly funded, you probably shouldn't need to use that. But it is kind of this peace of mind that you can have when you have an IUL that, for whatever reason, as you get into your later years, you might want to trigger that overloan protection rider.
Yeah, I call it the pull the ripcord in an emergency rider. We don't expect to use it, but if you're facing a lapsed policy because you either accidentally borrowed too much or you decide to borrow too much on purpose, if you're using that cash value to live on and you end up borrowing too much, the worst thing in the world is that your policy lapses, and not only do you not have any more money to pull out of that policy to live on, but you will also get hit with a tax bill.
Yep, and that's why I think it's important. But again, to circle back to like the original thing is really you as a client or even as an insurance agent, you don't have to know what is said inside of the text of TEFRA, DEFRA, or TAMRA, or any of these things. It's really what are the effects of that, and really that comes into play inside of the software that is used to do these illustrations. So it's not something you have to memorize, but understanding those concepts can be helpful for an agent to understand why certain things are done.
Now, there's one newer wrinkle. In 2021, there were changes made to the 7702 limits. Well, that had to do with TEFRA and DEFRA. I think DEFRA specifically, where it used to be that whole life companies had to have a guarantee rate of 4%, and that changed because of lobbying and whatnot. After COVID, the government finally gave in and allowed insurance companies to reduce those guarantees to as low as 2%. They actually created a window between 2 and 3.75%. Now, most of the policies ended up dropping to 3%. And that really allowed a lot of these insurance companies who had been facing reducing interest rates for the last decade to get some relief on their books, because the higher the guarantees, the more they have to have in reserves. And of course, they've got to make sure that they're meeting that 4% reserve, even though the overall interest rate environment might not have been sustainable for their portfolio to sustain that.
And you got to think about the time in which this was happening, where rates had been near zero and then effectively dropped to zero for a period of time. And that's probably the lowest interest rates that I've ever seen in my lifetime is that time frame when, that early COVID and the first couple years, interest rates were rock bottom, and they had been for a decade because of the response to the financial crisis. So these insurance companies were paying these dividends and in excess of the guarantees, but as James mentioned, that's those guarantees all impact their ability to on how much they have to keep in reserves and various factors. These companies are not operating like your fractional reserve banking companies that your normal banks operate. So it was an important factor, although in general, the companies that we work with are tending to pay well above those guaranteed rates anyway.
And I'll say one last note on these guaranteed rates, since we like to pull back the curtain on these things. The policies with the lower guarantees end up with higher internal rates of return. Part of that is because you can effectively put more extra dollars into a policy with a 2% guarantee with the same death benefit as a policy that will have a 3% guarantee or a 3.75. Or there's even some out there right now that have a 4.5% guarantee. But the cash growth inside of those is not very attractive.
Yeah, and that's a thing too. So there's a lot of talk about this guarantees and all of that. In the end, on the whole life side, we're getting into these policies for the surplus dividends as well, and that amount that is beyond those guarantees, and cash performance, that internal rate of return, can be higher when you have lower guarantees, and there's a lot of factors that play into that.
All right, just to button this up, be aware TEFRA and DEFRA are not the MEC rules. You can have a policy that satisfies TEFRA and DEFRA, but is still a MEC, because a MEC can still be life insurance. However, it gets taxed differently. It doesn't get taxed like life insurance, and that's where the real problems can come into that. A MEC is modified endowment contract, if we didn't already mention it, but there are different rules. That's TAMRA that covers MEC rules. So just wanted to be clear on that, so I don't think we missed anything when it comes to TEFRA and DEFRA. But if we did, just know that it doesn't really matter.
We've really covered all that you need to know and some in this episode.
All right, next week, we're going to talk about what boring asset class can outperform your 401k in a volatile market. You might have an idea of what we'll be talking about, but we'll reveal it for sure next week. With that, I'm your host, James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance, and we'll work with life insurance clients across the country as well.
Thanks for joining us. We'll see you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.